Everyone. In today's video, we are going to study about the break-even analysis. To begin with, let us start by knowing the meaning of break-even analysis. So, a break-even analysis seeks to investigate the interrelationships among a firm's sale revenue or total turnover, cost, and profits as they relate to alternative levels of output. A profit maximizing firm's initial objective is to cover all the cost and thus to reach the break-even point, which means when the company makes no profit, no loss on the sales, it is called as a break-even analysis. It makes net profit thereafter. This is explained with the example of a break-even chart. The basic formula for break-even analysis is derived by dividing the total fixed cost of production by the contribution per unit. This is the formula which is used for calculating the break-even point in quantity. That is, fixed cost divided by contribution per unit or fixed cost divided by selling price minus variable cost. The contribution is calculated by selling price per unit minus variable cost per unit. Let us understand this by the break-even chart. The concept like total fixed cost, total variable cost and total revenue are shown respectively. respectively. The break-even chart shows the extent of profit or loss of the firm at different level of activity. As you can see, that the variable cost, fixed cost, it is in the marginal line. The break-even point are been intersecting when there is no profit and no loss for the company. The net profit, which is derived after the break-even point. This is the TRTC fixed cost and unit of production. In this diagram, output is shown on the horizontal axis and cost and revenue on vertical axis. Total revenue curve is shown as linear as it is assumed that the price is constant. Irrespective of the output, this assumption is appropriate only if the firm is operating under perfectly competitive conditions. Linearity of the total cost curve results from the assumption of constant variable cost. It should also be noted that the TR curve is drawn as a straight line through the origin. Every unit of the output contributes a constant amount of total revenue, while the total cost curve is a straight line originating from the vertical axis. Because total cost comparisons constant or fixed cost plus variable cost which arrive linearly. In the figure, B is the break-even point at OQ level of the output. Now let us understand the assumptions of break-even analysis. The total cost may be classified into two types, that is fixed and variable cost. It ignores semi-variable cost. Here, the cost remain constant over the volume under consideration as they are the fixed cost. It assumes constant rate of increase in variable cost depending upon the situations or marketing conditions. The cost and revenue function remain linear, but the price of the product is assumed to be constant. The volume of sale and volume of production are equal at the point. It assumes constant technology and there is no improvement in labor efficiency. The price of the product it is assumed to be constant. Managerial use of break-even analysis. The first one is safety margin. The break-even chart helps the management to know at a glance the profit generated at the various level of sales. The safety margin refers to the extent to which the firm can afford a decline before it starts increasing losses. The formula to determine the sales safety margin is equals to sales minus BEP divided by sales into 100. Now, it focuses on the target profit. In the break-even analysis, it can be utilized for the purpose of calculating the volume of sales that are necessary to achieve a target profit. Change in price. The management is often faced with the problem of whether to reduce price or not. Before taking a decision on this question, the management will have to consider a profit. A reduction in price leads to a reduction in contribution margin. This means that the volume of sales will have to be increased even to maintain the previous level of profit. The higher the reduction in the contribution margin, the higher is the increase in sales needed to ensure the previous profit. Change in cost. When cost undergo change, the selling price and the quantity produced and sold also undergoes the changes. Now let us understand a few limitations that are in the break-even analysis. Keeping important factor constant is a drawback. Example, the profit factor. If the profit has been increased a year back, it makes a demand in the present year to change or to overcome that profit margin comparison with the last year profit margin. So, if the company has earned 2 lakh rupees last year as profit, this year it has to earn more than 2 lakh. That is the drawback for keeping the break even analysis. The projected future with constant factors will not give correct results. As it is not a future oriented, the results of time cannot be considered as a nominal or picture perfect for forecasting the future projects. Assumption of cost revenue output relation is only true for short run. It cannot be made for a long run purpose. A simple form of break even chart makes no provision for tax and corporate income. Hence, the company has to deduct all the profit. To get the profit, it has to deduct tax and corporate income as well, which makes a less profit for the company. Matching cost with output imposes another limitation on break-even analysis. Due to much assumptions, break-even analysis has become an approximation rather than an exact form of calculating the profit, as it only clarifies what is the point where company will earn no loss and no profit. It is assumed to be a approximation rather than the exact value or exact number of break-even analysis. Thank you so much for your valuable time.